Now the topic before us is a deep dive into determinants shaping the money multiplier. We understand that we have a formula to calculate money multiplier. What is that? Money multiplier is equal to 1 over reserve ratio. The money multiplier effect will be fully effective if banks lend out all of their excess reserves. It means that if we are having, if the bank is having deposit of say $1,000 and the reserve ratio is say 10%, then the banks will keep $100 as reserves and they will use the balance amount of $900 as loans. They will give all this amount which is excess reserves as loans. They will give all this amount on loan. Further, all money created by the banking system remains within the banking system and is not withdrawn as currency. That is, when this amount is given as loan, this $900 again get redeposited into the banking system. When this amount is used for the purpose of say purchasing goods or availing services or paying debts, then the person receiving this amount deposits all this amount in the banking system and this money again becomes part of the banking system and no amount of this $900 is kept by the recipient as cash at home. That is, all this money gets redeposited into the bank and no amount is kept aside as cash at home. However, such assumptions are not practical in the real world. It is also possible that reserve ratio which is set by the central bank may change, which will also affect the money multiplier. In the real world, many factors influence or affect the money multiplier. First is reserve requirement, currency holding, desire to hold excess reserves, demand for loans. We will discuss each and every point one by one. First is reserve requirement. We have already learnt that suppose if $1,000 is the deposit with the bank and reserve ratio is say 10%, and then after keeping $100 as reserve, the bank will be in a position to give $900 on loan. Suppose if the reserve requirement is changed, what will happen? If the reserve requirement is changed, then suppose it becomes 20%, then $200 will be kept as reserves and this amount will be available for loans. So when this 900, we again come to the first point, when this $900 is given as loan, this amount will be used by the person receiving for the purpose of say purchasing goods, availing services or paying back debts. This amount again gets deposited into the banking system and again keeping the reserves of 10%, it will be creating $810 as loan. This is the first case. But if the reserve requirement is more, what will happen? If the reserve requirement is more, what will happen? The banks will be in a position to give only $800 as loan, and when this amount is expended by the recipient or the person receiving the loan, it will again get deposited into the banking system as deposit, and after keeping 20%, the balance amount of 640 will be available as loan in the second case. So in the first case, you will observe that when the reserve requirement was less, the loan was more. Here deposit was increasing on the higher side. But if the reserve requirement is set at higher point by the central bank, the loans are also on the lesser side which are being provided. So when the reserve requirement is increased, it will adversely affect the money multiplier. Money supply in the economy will decrease. It will have adverse effect. As you know that formula for money multiplier is 1 over reserve requirement. Reserve requirement is changed. Suppose from, if it is 20%, it is 5. If it is say 25%, the money multiplier will become 4. So as the reserve requirement is changed, money multiplier is also changed. Now the second point, currency holding. If the person have the desire to keep more amount as cash, the less amount is deposited. Suppose the we are having $100 with us. There are two options. We deposit all this amount as in the bank, or it may be possible that we deposit only $800 in the bank and keep $200 in cash at our home. So in this case, when $1,000 completely are deposited in the bank, it will result into higher multiplier, higher money multiplier, because the money supply will be based on this initial deposit. Here you can see that after keeping the reserve requirement, say 10%, the banks will be in a position to give $900 on loan, and there is a money multiplier process, as you have already learned. But here, if the banks receive only deposit of $800 instead of $1,000, then the banks will be in a position to give only $720 on loan. So this amount will be available for loan. So if the currency holding is on the higher side, here the currency holding was nil, 0. Here the currency holding is 20%. So if the currency holding increases, it will negatively affect the money multiplier process. Money supply in the economy will decrease. It will adversely affect the money multiplier. Now we will come desire to hold excess reserves. We have already learned that reserve requirement ratio is set by the central bank, and normally it is set at 10%. However, it may change from country to country as it is decided by the central bank of the country, keeping in view the economic conditions of the country. Suppose we assume that it is 10%. Suppose deposits are $1,000 with the bank, and the banks have legally they have to keep 10% as reserves, that is $100 as reserves, and they can give $900 as a loan. They can. But if the banks decide that they should keep some more amount as reserves, that is instead of this legally binded reserve ratio, they may opt for say 15% as reserves, keeping in with the economic conditions, economic uncertainties. The bank may decide that it will keep more amount as reserves, and it will give only $850 as loans. So here it will adversely affect the money multiplier, because money multiplier is based on 1 over reserve ratio. If it is 10%, the money multiplier is 10, because it becomes 100 over 10, and the money multiplier is 10. But if the money multiplier, if the reserve ratio is here, it is not the dictated reserve ratio of 15%. Here 10% is the reserve ratio as set by the central bank, and 5% is the reserve ratio which the bank has opted for itself. So if the reserve ratio becomes, if the reserve which has been decided to be kept aside as by the bank becomes 15%, what will happen? It will become 100 over 15. So you will observe that if the excess reserves are held by the bank, then it will adversely affect the money multiplier. Now the other is demand for loans. Here we have already learnt that after keeping the reserve ratio, they can say give $800 as loans. They have this amount as loan available. They can give, banks can give this amount as loan. But if the market conditions are such that the borrowers, that is the individuals or the businessmen, are not coming forward to avail the loan, then it will adversely affect the money multiplier, because the money supply in the market will decrease, because when the persons will not come to avail loan, the reserves, excess reserves will lie with the bank without being utilized as loans. Now suppose in this competitive world we are also using online sites to purchase products from overseas. Suppose if a person uses sum of money to buy a product online that was manufactured in a foreign market, in such a case what will happen? The purchase money will go out of the nation and the economy. It will also adversely affect the multiplier effect. Now we have discussed many factors which influence the money multiplier. These determinants influence how much money banks can create through the lending process, affecting the overall money multiplier in the economy. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.